This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello, welcome to a special edition of the AJ Bell Money and Markets podcast. Now, we've just had the budget announcement and we're going to have a quick chat now to go through some of the key points and what it really means for your money. So I'm Dan Coatsworth and joining me is Charlene Young and Danni Hewson. Hi there.
Hello.
Hi, Dan.
Yeah, normally we would give you a sort of menu to what we're about to talk about, but obviously this one's a bit different. So instead, we've spent the last couple of hours trying to skim through the 170 pages of the document released by the Treasury after Rachel Reeves was on her feet for what felt like a very long time for her maiden budget. We're going to pull out some of the headlines and discuss immediate market reaction.
Yeah, and like Danni mentions, we've got over 170 pages to go through, so it's going to take some time to go through that small print in further detail, and I think probably we'll be digesting what the huge changes to tax and spending are going to mean for each of us and the economy as a whole for years to come.
Yeah, of course, we're not going through all 170 pages on this podcast before you're listening thinking, oh my God, I'll strap myself in. But no, we're going to give you the absolute highlights. And I think the key thing is for us is there was a real positive market reaction to it. I think when Rachel Reeves came out and said that from 2028, there won't be this ongoing freeze to income tax thresholds and national insurance thresholds. I think that gave people some glimmer of hope that actually, you're not going to have this huge wave of people when they get pay rise all moving into higher sort of levels of earnings categories. So, I think that overall the sentiment was so weak going into it, wasn't it? I think that it was. There were tough decisions in there, but I don't think that it was catastrophic as we could have had. So I think that overall we had the FTSE 250 index, which is a lot of UK domestic companies in there were going up, and just generally I think positive reaction. Whether it lasts is another thing, because obviously the devil's in the detail, and lots of things for businesses to digest, and perhaps their costs are going to go up, and so maybe this initial positive reaction, who knows, will it last? It
was really interesting because some of it was sector specific, wasn't it? So we saw gambling companies like Entain. I mean, that is still topping the FTSE 100, and that is because all the speculation about potential tax increases that they would have to face, none of that was in this budget. We also had huge commitment to house building targets, which of course gave house builders a bit of a boost. And we also had moves on business rates. Now, for retail and hospitality and leisure in particular, they've been looking at this cliff edge. They've only had to pay 25%. They've had this 75% cut to business rates, but it was due to end in April. Now, what the government said is that they're not going to extend that, but they're going to replace it with a 40% discount for the 25-26 year, and then look more closely at business rates going forward. So I think that certainly helped. Obviously, there is still going to be a great deal of pain. And what you said about the immediate reaction, I've noticed just in the last half an hour or so, things sort of ebbing away a little bit.
Yeah, I mean, we had, if you look at gilt rates, so this is the UK government bond, the yield on them, that's actually gone up to a 5-month high, just around 4.4%. And what that is, the market is saying, look, it's clear that the Chancellor says, she kept saying we want to invest. And of course, that means borrowing more money. So that's the market pricing in saying we're going to have to borrow more money because they've loosened the rules about allowing more capital investment for schools, for hospitals, for green energy projects. And so essentially what they're doing is they're taking into account financial assets and liabilities on the balance sheet. So it's a sort of slight technical thing here, but it just means that they can borrow a little bit more money. Sterling was interesting, it went up and down, but we didn't get, importantly, we didn't get this sort of chaos that we saw when we had the mini budget with the Liz Truss era. I think that's the most important thing, that we haven't had panic on the markets.
No, and much of this budget had been heavily trailed beforehand. I think we had 93 days of messaging about what difficult decisions may or may not come. Yes, I did add that up. But there were some surprises in the detail, as we mentioned. Now, we knew what taxes wouldn't be going up. Heavily trailed taxes would not go up for working people. Some rumours about what exactly working people might mean. And they didn't go up. But whatever you think also about rising national insurance for employers, I think it is fair to say that perhaps some of the rises weren't quite as bad as the rhetoric in the lead-up was suggesting.
I think the devil is very much going to be in the detail when it comes to these national insurance increases. I'm sure you've probably heard it so many times now, but let's go through the headlines. So national insurance for employers is going to rise from 13.8% to 15%. Now, there had been speculation that it would go up by 2%, so clearly not quite that much. However, the threshold at which employers start to pay national insurance almost halves from 9,100 to 5,000. So, that is pretty chunky, and we've been doing some of the sums on how much more a lot of these changes potentially could impact employers. Now, I know we're going to talk about minimum wage in a minute, but when you look at some of the big changes, including these national insurance increases, put together, it means that a cost to business almost £2,400 more to employ someone on the minimum wage working 35 hours a week. Now, I know small businesses in particular were really concerned about this, and businesses in general are saying, well, look, it's not a tax on workers per se, but it could be down the line, because if employers have to pay for this, it's got to come from somewhere. So they may think about not giving as bulky a pay increase as they'd thought to. They might think about not hiring as many people as they'd potentially thought to. Again, a lot of comment about, is it a tax on jobs? Isn't it a tax on jobs? Now, I know that for smaller employers, there is certainly an extra allowance that they get, the employer's allowance. That has gone up from £5,000 to £10,500. But if you're a bigger company, that £10,500 is going to disappear very quickly. And I think even Rachel Reeves said when she stood up, look, for a small business, you can effectively employ 4 people on the national living wage full time and not have to pay national insurance. But there'll be a lot of businesses that are 5, 6, 7 and are finding that the changes to business rates, the changing to taxation are going to be a real drain on them.
Yeah, I think, in addition to employer national insurance changes, we've had changes to employment rights, things like trying to get rid of exploitative 0 hours contracts, new rights for people accessing sick pay, but they've also had changes obviously to minimum wage. So these 3 things do put big pressures on companies. So if they have to stomach all these extra costs, it means their profit margins will be hit. And that, of course, will have an effect onto their share price, or highly likely to have an impact on their share price. But if they pass that cost on to the customer, that means that the cost of living could go up again. I mean, those minimum wages from next April, so over 21, so moving from £11.44 an hour to £12.21. Aged 18 to 20 is going from £8.60 to £10 an hour. So particularly if you think the leisure industry, hospitality, retailers, they've all that really does matter to them. It might seem like, it's only a tiny extra few pennies to a salary, but these things really add up when you've got a very, very large sort of labour force.
Yeah, and so whilst we're talking jobs and pay, and there was lots of jeering when Rachel Reeves was sort of teasing the other side about unfair dismissal changes that were coming in, I think that contributed to the length of the speech there. One thing that was in those rumours in those 93 days was that tax thresholds would be frozen for even longer. So as we know, under the previous government, personal allowances and tax thresholds were frozen through to 2028. That was already been extended once, and we thought that they were going to be frozen some more until 2030. Now, there was a bit of a collective cheer amongst ourselves when Rachel Reeves revealed that they would not be frozen, and from 2028, those personal tax thresholds will once again finally be uprated in line with inflation, hopefully bringing an end to, you know, the effects of fiscal drag that had been felt amongst people earning.
So I think, you know, should we sort of talk about some other personal finance changes then? So, I think it was in many cases that they've been trailed, lots of speculation, but in reality, they're not as bad as feared.
Yeah, so first up, pensions, and I always like to sort of lead with the good news. Now, no changes to the way contributions are treated and the tax relief that's given on those, and that much feared reduction that was rumoured to tax-free cash. So really good news there for pension savers, and we're obviously pleased about that. It still feels that some kind of commitment, you know, we were calling for this pensions tax lock to give a bit more confidence long-term for savers, you know, locking their money away for retirement.
Absolutely. Potentially, though, we do have a big change when it comes to inheritance tax.
Yeah, so the government has announced and they've actually released the consultation already. It's open and will close in the new year, about changes bringing unspent pensions when people die into their estate for inheritance tax purposes. That could come in from 2027. So that's obviously a big change to the way pensions are currently treated when someone passes away. The government has said that they think it'll impact about 0.3% of estates, but we'll kind of see some of the detail and what might change come out in that consultation, and obviously something we will be taking a very keen interest in. One threshold which will remain frozen till 2030 is the nil rate ban for inheritance tax. So broadly speaking, everyone can give away up to £325,000 when they die, and that is tax-free for their beneficiaries. There's also a residence nil rate ban that will be frozen as well. That's worth £175,000 per person. Now, what does that mean? That means effectively a couple could actually pass on up to £1 million between them to their beneficiaries before inheritance tax comes into play, if they're passing on a property to their sort of what we call direct descendants. Now, those thresholds are going to remain frozen. So whilst IHT currently impacts, we make it about 4% of estates. Rachel Reeves mentioned 6% in her speech, so I'll be interested to kind of have a look at the detail of that figure. You know, it might begin by 2030 to drag more of those estates into paying tax. Some big changes to business property relief and agricultural property relief too. So at present, assets that qualify for these reliefs get IHT exemption effectively. They get 100% relief when someone dies. So it's there. It's been in place for many years to prevent people benefiting from small businesses, having to sell that business or break up a farm, for instance, to pay an IHT bill. Now, people will still be able to leave £1 million of these types of assets, and these will still get IHT relief, 100%. But anything above that £1 million asset threshold will benefit from a lower rate of IHT relief. That relief will be cut to 50%, effectively meaning that IHT of 20% could be charged on assets worth more than £1 million. Now, those reliefs were worth around £4 billion combined back in 2021-22, which is when we have the last figures from HMRC here. So it actually made them the kind of second most valuable IHT relief. So it's kind of clear to see why Rachel Reeves has possibly targeted those. And Dan, there was some news on IHT and AIM shares as well, wasn't there?
Yeah, a lot of people invest in certain types of AIM shares because they qualify, like I say, for business property relief, so it's for inheritance tax planning. So there was speculation that Rachel Reeves might come along saying, sorry, none of these AIM shares qualify for IHT relief anymore. And there was a fear that that could cause a big sell-off in the AIM market. So for those who are listening and perhaps not familiar, there's a junior part of the London Stock Exchange, and so this is the AIM market, typically smaller companies. And so there was a fear that we saw some initial sort of selling in certain stocks and that this would accelerate. But actually she came out and said, not going to be scrapped completely, but 50% relief instead of 100%. So that triggered a big jump in, there's something called the FTSE 100 AIM index. AIM is not really an index that people follow in the way that we talk about FTSE 250, FTSE 100, but big rally in AIM shares, big relief rally here. And I think this is typically an area for private investors love to look for these sort of opportunities. They're higher risk, but it does show that this AIM market is not going to be killed off completely, which I think some of the sort of more sensational, dramatic headlines that we saw. So it is a real sort of relief to anyone who's sort of perhaps actively trading shares in the market.
Now, you guys have been mentioning some positives. I'm going to deliver a few more, just top lining a few things here. So fuel duty, there'd been a lot of discussion about whether the freeze on fuel duty would continue. The RSE had even said that maybe it didn't need to because a lot of retailers weren't passing it on to motorists. Anyway, Rachel Reeves has said, no, we know things are still tight for a lot of you. We are going to keep it frozen. Duty on a pint in the pub, and I think this got the biggest cheer of the day. That's going to be reduced by a penny on a pint of draft ale, but other alcohol will go up by RPI, and I've already seen a lot of whiskey manufacturers tweeting about this, being very concerned about the potential impact. Something that we've been celebrating here, the British ISA that we've been talking about for a while, not particularly excited about the prospect. It's not going to make it off the drawing board. So, of course, this now gives the Labour government a real opportunity to look at ISA simplification, to try and get more people to invest, because that's what they have been talking about. The ISA allowance, there was maybe a few nerves that it could be tweaked a bit. That's staying where it is at £20,000. What did surprise me, though, is there wasn't a huge amount to try and get more first-time buyers on the ladder. We've seen changes to their stamp duty threshold, the help that they were being given. That was already announced before the budget. There was only one thing really that caught my eye on that, and that is that there's going to be an additional surcharge for second homes. It's going to go from 2.2% to 5%, and that's overnight, and also a huge expenditure on house building, which hopefully will create more affordable homes, which will hopefully make it easier for people to get a home. 1.5 billion new homes over this Parliament. But I think there'll be a lot of people looking at this budget and thinking, OK, there was quite a lot that was missing, maybe.
Yeah, and I think, we like the pension tax laws, there is an opportunity here for the government to kind of reconsider that ISA simplification. As you mentioned, the ISA allowance will be staying frozen at £20,000, the junior ISA allowance also at £9,000 for the tax year. And those ISA wrappers become more important than ever with changes to capital gains tax that were announced. So this isn't an overnight one. These changes actually came in today. And I don't think that was kind of highlighted in the speech. It's something we've picked out from that detail. So from today, 30th of October, the rates of capital gains tax for non-property assets, so our investments, go up. So for someone with gains within that basic rate income tax band, that rate of CGT goes up now from 10% to 18%, so quite a jump there. And the higher rate is going up from the current 20% to 24%. So this does put investments and property gains on an even keel, although the reporting rules, I should mention, are still stricter for those second property gains.
It's probably just worth a quick mention about private equity as well. This is perhaps for private equity managers, so essentially for the part of the fund management industry. They get charged capital gains tax on performance fees when they sell an asset, and so this is moving from 28% to 32%. But I think overall, again, it's one of these sort of situations where it could have been a lot worse, couldn't it? So.
Yeah, there was talk about that moving fully across to income tax. That could, for those managers, have been up to 45%.
Could have been a lot worse, but I have to say that overall, just looking at the reaction, even though there is some of that, there's also a distinct lack of oomph about people's reaction to this budget. I think people felt that the messaging that came ahead of the budget was really depressing. It really knocked consumer confidence, and it's going to be really hard to turn that around. And it doesn't matter that we've had huge amounts of investment announced in things like the NHS, in things like infrastructure, in things like British Energy, all of those things. There's cash going into that. But in terms of stimulating growth, and we had some figures from the OBR, Dan, and it's not looking all that rosy.
Well, no, we need it for businesses to feel confident to invest, to create more jobs, to do more things, to expand, for consumers to spend more money. But these OBR figures don't exactly suggest an economy racing ahead. They're predicting 1.1% GDP growth this year, 2% next year, but then after that, it's all less than 2% annual growth. Now, don't forget, when Labour was campaigning in its general election, it said we want to make the UK fastest growing G7 nation. Well, something sub 2% is not going to suddenly overtake some of our rivals. So you're right in saying it's, they came out with this message saying it's all about creating stability for public finances and then going on to growth. Well, it does seem like we're going to have to be waiting quite a while before this growth comes. But I think the overall theme of it was, I think lots of people are going to be sitting back and saying, yes, it's going to affect my personal finances. Not going to be quite as bad as I thought, but I'm not going to be sitting here feeling incredibly flush. I'm not going to suddenly rush out spending lots of money. And I'm sure over the coming days, and we'll probably come back to this on next week's podcast, someone will have found something to go, perhaps thinking about it. But so I hope everyone listening to this now, that was helpful. It was. We are recording this literally a couple of hours after the budget announcement. I hope it was useful. We will come back to it in more detail, no doubt, over the coming weeks. But for now, I'll say hopefully that was a good, useful podcast for you. Sorry, it's shorter than normal. You will get an episode of our monthly bonus investment trust podcast coming in the next few days. And then next week, we will be back with the normal format for the AJ Bell Money Markets podcast. Until then, thank you very much for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.